Are you thinking about buying or upgrading your home, but you're trying to figure out solutions to do so? If you have a lot of money in the stock account, you have the ability to borrow money against it. However, most of the options that are available today are very cumbersome and they are very expensive. In today's webinar, I am with the founders of SyntheticFi so that you can determine for yourself whether this option can allow you to, one, borrow the best rates possible, but also number two, allow you to accomplish your goals without having to sell stocks and without having to pay the taxes on that, and potentially a great benefit of having some tax benefits from this. This solution used to be only available for the ultra rich. However, nowadays with these new companies, they allow you the exposure and the opportunity that the ultra rich has that is democratized for everyone else. If you find this video helpful, be sure to share with your friends. My name is Spencer Su. I'm a real estate professional in the Bay Area, and I know you're going to like this video. Well, thank you, team at SyntheticFi, for joining for this webinar. The purpose of me setting it up, when Joseph and I had a conversation, I think maybe a couple of weeks ago, I always knew about people have a lot of money in their stock accounts, and they are always in the decision of, do you sell your stocks to buy real estate or do something else with it, or can you potentially borrow against it? And the concept of borrow against stocks has been around for a while. It's not as widely known as people may think, and the cost structure uh, is usually higher for many. And so when I had the conversation with Joseph and his team at SyntheticFi, I was like, wow, this is a really different way of positioning that high level concept at a rate that is, quite frankly, many times maybe even better than a traditional mortgage rate today. So when I knew of that, and I knew there were people like, to give you some background, I have some clients and some friends are at like Morgan Stanley. They do have options where they're able to get some incredible rates at 4%, but that wasn't the norm, right? Most people are not able to tap into it. So when I heard about the options that you guys had, I knew this could be serving a much wider audience. This ability can be exposed to more people, and that's why I wanted to get this webinar in place. So without further ado, let's have the team at SyntheticFi first share, and you can go ahead and share your screen now, about a little bit of the history of it, maybe about you guys, what is this thing, and then afterwards we'll jump into questions, Q&A, that may supplement this, but also some further clarifications. So Joseph, I'll leave you to it.
Absolutely. Thank you so much, Spencer. What a warm welcome in such a dark, flu-ridden day. But really, really appreciate it. And my name is Joseph. I'm the founder of SyntheticFi. We facilitate security-backed lending products for a variety of use cases. And here we do think using a security-backed loan for real estate, either for the purchase or for HELOCs, or just for like some bridge loan, will be super beneficial for your finances and be able to have all your assets work for you. That's the subtitle here, which both means that you don't have to sell if you have a portfolio, but also means that you're able to get such a cheap rate with the portfolio that you have. Joining me here also is my co-founder, Tony. Say hi, Tony.
Great to meet you all. I'm so excited to tell you guys about what we've been building.
Yeah, he is the genius behind all this. I'm just not so pretty face, but wish we could answer any questions here. So how I want to run through is we have just very simple slides. This is really more meant for conversation and trying to get your questions out there than anything. So I run through these and we'll spend most of the time answering specific questions, details you want to know, or any particular application that you can think of as of now. So why don't we get started? So security-backed loan, just to give a little bit background, security-backed loans for borrowing or for real estate has been common in the ultra high net worth arena for a relatively long time. So those are the people with tens of millions of dollars, hundreds of millions of dollars. And this has been an easy way for people to tap into that kind of liquidity. For those people, they're able to get loans, as Spencer mentioned, for around 4%, even at 0 point something percent, when it was 2020, 2021, when the rates are super low. Because if you think about it, you already own the security, you're pledging your security and getting a loan, and the people who are holding the security as all the assurance they really have that you can repay, because it's right there. It's like cash. It's in your account right there. So there's no reason there's any credit risk. So the rate they give is super, super low. However, this has not been accessible for the consumer market, not even for like people with millions of dollars, let alone just like some common folks like us. So what we really want to do here is to bring a product or bring an offering that you can really combine with a variety of use cases. No matter you just want to furnish like a HELOC, like furnish a countertop with your HELOC, or just pay some down payment because you don't have that much Apple stock in your account. That being said, here's some of the most common use cases that we see with securities back lending and with real estate. So the high level is we really want to keep our stocks in our portfolio and work for us. 2 reasons. 1, they might go up. Second, you really don't want to pay the capital gains tax when you sell those stocks. Those could be significantly bad if you have held, let's say, Apple for the past 10 years. That will be taking your arm and leg just to sell, and you're already taking a hit on the real estate transaction itself. So why are you taking double hits from all areas? So by keeping your stock exactly where it is and borrowing against it, you can finance a variety of loans at very cheap rates. So we do see these are some common loans. One is bridge loan. Just if you're moving to a larger house, a nicer house, but don't have cash to pay the down payment or pay it off right now, there's a solution for that. Very common will be home purchases, from just down payment to regular arm mortgage to investment property loans. Security-backed line of credit, security-backed loans got you handled. And even for a HELOC, where we see 8+ percentage point or like 9+ percentage point interest rate, and you have your house pledged, security-backed line of credit and security-backed loans can get you interest rate around 4 to 5%. So this is a good segue into why you even should consider it in the first place, because it's just so darn cheap. It really is have some of the lowest interest rate on the market. And especially for longer term use cases, let's say you want to lock in the interest rate like a 5-year arm, interest rate here is sub 5%. So we're looking at 4.6 to 4.8. On top of that, this interest is tax deductible. So interest here, we'll go into that, how the mechanics later, but interest here is tax deductible as a capital loss, accordance with IRS section 1256. So that would be 60% deductible against long-term capital loss and 40% deductible against short-term capital loss. That will bring your effective financing rate to this 5-year loan or 5-year arm into 3%, into the arena of 3-point-something percentage points. This is really the bread and butter of what we do, is just the low rates you can access and make this rate work for you. So that kind of addresses the first large bullet point it has. It's like, why do we even have security-backed loans to do this? One is just cheap. Second, this loan is super flexible. This loan, we can structure it to your liking, but the common way to structure it is to be interest only, meaning that you only have to pay interest for the duration of this loan. And you can also refinance at the end of the duration, let's say 5 years. At the end of 5 years, you can put it into a floating facility, refinance it into another regular mortgage, or have a regular 6-month adjustment rate to ARM, whatever that works for you. So terms here really caters to your specific cash flow needs and your specific scenario. Third is, again, I touched on a little bit before, is the tax benefits, both from the interest rate deduction, but also from not selling your stock, not selling your portfolio to pay the capital gains. Additional benefit for people who are thinking about buying a home is the loan, quote unquote loan, or the cash you get up front here is considered literal cash. So let's say you have $10 million and want to buy a $5 million home and finance it entirely with a security-backed line of credit. This is considered a cash offer. So you can become more competitive in your bidding and have assurance, and your sellers will have assurance that they will actually get the money very easily. And last, a little bit I want to touch on is for a lot of people who are real estate investors, additional benefit is this loan does not require credit checks and has no impact on DTI. So this is entirely backed by your portfolio. So it has nothing to do with your personal income or personal debt, and is self-contained in the portfolio itself. There are some additional benefits, including there's very low minimum, which is particular pertinent to HELOC use cases. The lowest amount you can take out, like you can have a line of 10K, and it's also custodian and bank agnostic, meaning that you don't have to be like, hey, this is a Morgan Stanley offering, so you have to move your asset to Morgan Stanley. Your asset and loans can stay exactly where it is. Yeah, you're able to get all the benefits. So those are the general benefits we provide as a service. So we provide as a security-backed line of credit provider. So any questions there I want to gauge, because I know I've already gone through quite a bit.
Did you have more that you want to share, or is it now we can just jump into all the questions, period?
I think we can jump into all the questions, period, if we want to. A lot, like rest of it is just a little bit plug of why we are the person who should do this job. But those, like, we'll leave the self-gloating to later.
No worries. I think it'll be good though for people to have a little bit of background about how where you guys came from, and then how did you guys come up with this solution, right? I think the framing of why use you guys is also important. So why don't you share that, and then I'll ask a bunch of questions.
Absolutely. So my background has been coming from the ultra high net worth background. I have worked for a family office for 2-3 years. During the time, they have been used security-backed loans, the type that we are providing here, to finance a lot of their purchases. And additionally, they bought a ranch. So, and I was like, okay, this is something that's really cool. Like they're getting super low interest rates at 0.something%, 1% during 2020. I was like, there's no reason we can't publicize or like democratize this product to more people who, to be honest, need it much more than some billionaire out there. So that is my background and where I come from. Tony here, I'll leave it to Tony. Like, how did you get into something like this?
Well, I bought my property in Millbrae back in 2021, and I had a bunch of stocks from my time working in big tech. So we actually deployed what we're doing here, borrowing against my stocks to help pay for the down payment of my house in Millbrae, which I'm sitting in right now.
And together we find it to be such a good opportunity. We got into Y Combinator. For those who don't know, it is a Bay Area-based startup accelerator who funded Stripe, Airbnb, some of the largest companies in the world. And they provide us with funding. And we currently work with more than 30 RIAs and also mortgage brokers as well.
Perfect. Yeah, so it's good for people to understand it, because everybody may have heard these huge headline articles whenever the media wants to portray it, right? Like, how are these billionaires not paying any taxes, yet they're like deploying and they're buying all sorts of stuff? And I'm sure there's many ways that they're doing it, but this is like one of the many vehicles that they use that has always been around for them. It's just for whatever reason, and we'll talk about momentarily, like why is this not more widely available, right? From all the Chase private clients, Wells Fargo Wealth Management, like why is this not more readily available, or why is your rate so much more than what you have? So we'll share like how you guys play and fit into this market when on one end it is available, but on another end there's not, I don't know if it's a reason, but there's some story as to uh, why this is just not more readily available, right? So you guys will kind of share about that in a bit too.
Absolutely. And one of the good things, which will actually help you with the YouTube algorithm, like as well, is this is exactly how Elon Musk financed a lot of his purchases, including Twitter, which he almost purchased with a loan like this, but kind of backed out last minute. Not sure why, but you never go wrong if you can borrow like Elon Musk.
Yeah, and the wealthier you are, it's kind of backward. It's not backwards, but the wealthier you are, I'm sure, I don't know what his rate would be because I'm sure it'll be very oversubscribed.
Yeah.
Every banker in the world would love to bank it, right? So they would have something crazy in terms of, I'm sure the rate. Who knows? Maybe it could be a negative rate because everybody would love to, right? So the wealthier you are, the more things they can figure out to throw at you to just try to lure your business, right? But that's not available
Yeah.
for everyone. And that's one of the cool things about this solution. Now, you can do it for whatever you want. Let's ask the first question about this. I think you may have covered it a little bit on the presentation, but what is the minimum that you can what's the minimum portfolio that people can even explore this? Like what's the total asset value needs to be to even use this?
Absolutely. So coming with the perspective that we want this to be something that everyone can use, the minimum portfolio is 50K. To be sure, that is 50K in your taxable portfolio. So we cannot lend against IRAs or 401ks because of IRS regulation. But anything else, as long as you have a portfolio more than 50K in securities, we are able to lend against and you're able to take advantage of the low rates.
Which is really low. Most, even if you think about a big bank wise, many of the big banks wouldn't even really even have you as a private client unless it was significantly more than that, right? So
Oh, absolutely. Yeah.
that's already significantly beneficial. Now, how does it work in terms of what's eligible to be borrowed against? Is it only stocks? Is it also treasury bonds? Like, what can they borrow against? And then, how do you guys determine what percent is borrowed that you can actually borrow against?
Great questions. So most securities are eligible to be borrowed under the scheme. That includes stocks, mutual funds, ETFs, bonds, bond funds, treasuries, and munis. So that is most of the universe. To be granted, there are certain securities that are excluded in this scheme, mostly concerning either super volatile stocks, meaning like the stocks only costing a cent, and they might go into like a 10,000 percentage in a day, and also includes highly leveraged ETFs, meaning like triple levered QQQ. So those kind of stuff have lower release rate. So the normal release rate that we have is 50%, meaning if you have $1 million, you can borrow 500K with the program. We have additional programs which can bump it up to around 85%, but those are special scenarios. Please talk to us if that's something that concerns you or interests you.
And then what about crypto these days? So on one end, if they bought a BlackRock ETF or something, I'm sure that will be probably fine. But is there any movement or any possibility where some people have done really, really well in Coinbase or something like that? Is there any
Yeah,
solution that you see a path, or is it even available to be able to borrow against crypto?
crypto will be difficult. I think the custodians and the people we work with are trying to add that to their portfolio, but currently the best we can do is we can't help you borrow against crypto ETFs. So that would be the IBITs of the world. That would be the Ethereum ETFs of the world. You can borrow up to 50%, so as a normal ETF, to against those securities. But just single ETF, single Bitcoin, single Ethereums, currently they are not supported.
Got it. Makes sense. Now, I'm sure people should have already thought to their mind when they first saw the presentation, how in the world is the interest rate so low when the federal funds rate is only a little bit below it, right? So, uh,
Yeah.
why don't you walk through a little bit of that? Like, why is it so low? And then let's then compare why does a big bank, if you wanted to do this today,
Mhm.
why is there so much generally higher from your understanding?
Absolutely. To be honest, the easiest answer is we are not as greedy as the big banks. We make money just by charging a very straightforward fee, which is 0.2% on annually on the loan amount. And the big banks like Schwab, like Morgan Stanley, like Wells Fargo, are charging credit spreads north of 2 or 3%. So we are making a tenth of what they're making, and that's making the biggest difference. How we're able to get such a low rate loan to your account is because we find the loan market and we basically translate your borrowing need. Here is the mortgage need, and to package it into a security that the loan market understands. And we then put this bid or put this loan onto the market, a market exchange, and have people bid on it. We have thousands, if not millions of, hundreds of millions of dollars bidding on these loans daily. So this competition is making these loans super competitive and super cheap. Once the bidding ends, we bring the loan back to you, and you have the cash and the liquidity to do whatever you want. Here, to purchase real estate, you can also just use it to buy a boat or buy a car, however you want to use this cash.
And so how is the rate determined on the back end side? So you put a range for today. Now that is always
Yeah.
subject to change, right? So what impacts this number?
It really is the Treasury yield. It's especially for the longer term loans that we have. So to be sure, we have loans that have duration either from monthly to all the way to 5 years. So here we mostly introduce our 5-year fixed loan, but if you just want a 3-year fixed or 1-year fixed, we also have offering. What determines the rate really is the cost of financing for the lenders on the other side, which is highly pegged to the Treasury yield.
Got it. And then you also mentioned a little bit of a glimpse of the term of it. So how do these terms work for a consumer? So let's say like what are their options? You mentioned like a 1 year, 3 year, 5 year, and
Yep.
like is the spread much different between them? How does that work? And what if they wanted to pay it off earlier? What does that mean, if anything?
Absolutely. So the spread between different loans are very similar. So the spread we see right now, we can't promise it's always going to be the spread, but the spread we see right now is 0.2% over Treasury yield. So that is consistent if you take out 5 years or take out 3 years. That translates to an interest rate of around 4.5 to 4.8%. No matter how long you borrow, it generally falls into this window. For early payment, the fixed interest here does introduce some risk for early repayment. So what we generally do for, let's say you want to pay off a certain amount per year on your loan, we will structure the loan in a way that allows you to do that. But the plain vanilla version of this loan does not allow you to do it. That's kind of the service that we provide here. We kind of cater the loan specifically to your use cases instead of just grabbing something the market already have and slap a name on it. We tailor and engineer it to your use case. So yes, you can definitely repay on a schedule. However, I would caution that early repayment will be subject to risk of interest rate differentials.
So what does that mean as an example? So if the rates go up a percent in a year and they
Yep.
want to clear out this option that they have, like what does that mean then for the consumer? Like what kind of payment example would that be?
Absolutely. So a real example that we have is someone locked down a 5-year interest, like a 5-year fixed rate, I think had like 6 months ago, and the rate has actually increased by around 1% or slightly less than 1% since then.
Yeah.
And this guy, Javier, say, hey, Joseph, I actually just want to get out of this loan. I don't want to hold it anymore. I want to just pay it off. He made money on this loan. So after factoring interest, he actually made money on this loan because the interest rate rose higher and other people have more incentive to take this loan away from him.
To give a specific example, Javier's loan was committing to pay about 3.8% for 5 years. When he was exiting it, the corresponding rate went up to 4.5. So the market looks at this and say, you got a good deal here. You're almost paying 1% less than everybody else for 5 years, guaranteed. So to take this great asset off your hands, we'll pay you a bonus. So that's what happened.
So in general, the theory is if rates go up, you actually may be okay, but it's the reverse. If rates happen to go down, then there'll be a bigger price to pay to get offload that debt.
That's correct.
Exactly.
And
Okay.
the worst case scenario is capped that we keep the loan outstanding until it expires. So
Right.
that's it, we hold it for 5 years.
Got it. Okay, makes sense. Now what happened? So technically, then, given you guys, let's confirm a few things so that people have the assurance. So let's say they have $100,000 at one of the providers that you guys work with. What's a provider that's a big name? Is like a Fidelity or anything like that? Like
Fidelity, Schwab, Interactive Brokers. We work with most large custodians.
Cool. So when I first heard of this, many times if you're working at a big bank, most of the big banks will require you to move your money from those accounts to them to be able to have access to that, right? So if you wanted to do it at Chase, you can't just leave it at Fidelity. You have to literally move the money over, and then they can do what they need to do. So number one, I want people to also understand, you guys can clarify that you're not moving that money into SyntheticFi brokerage account or something. Like you're still there, but you guys still have the ability to be able to help them run these different basically trades for that. So can you help clarify a little bit of how that's run? They're just leaving it as it is, but if you're at an authorized partner of yours, that's fine. That's the idea.
Absolutely. So a big benefit is your money stay exactly where it is, be it Schwab, Fidelity, or IBKR. We will trade a loan on your behalf and get a loan onto your account. Functionally, that will just look like your account suddenly have a ton of cash. And you can use that cash to either pay off your HELOC, refinance your HELOC, or to buy a real estate.
Got it.
So we don't take custody. So the important thing here is we don't take custody. We only have the ability to get the loan to you. We can't really touch the security, the apples, the treasury bonds that you hold.
Got it. Cool. And a question, because you're borrowing, you're leveraging up against the assets that you have, would be how does margin call work? What value does it need to drop to really have an impact related to this, right? So what's the downside risk or bar that they have to be mindful of?
Absolutely. This is the most important risk management in this area, is the margin call risk.
Right.
If you borrow to the maximum, that is 50% of your portfolio can withstand a 28.5% market drop before anything happens. If you borrow less than that, your portfolio can withstand a correspondingly higher drop in market without triggering our margin call. A safe rule of thumb we like to give people is to borrow 30%. So that in that way, your portfolio can withstand around a 65% market drop, which has not seen since the 1920s, the Great Depression. Even the 08 dropped less than that. So that is where we consider, hey, this is pretty safe and the risk is well managed.
Got it. Walk us through you mentioned about this side of the tax benefit side of it. And I think you mentioned a specific code. Now, we're not tax advisors. Maybe you guys are. You can comment on that. But share with what you know, or from you, when you talk to the tax professionals, why is this able to be deducted? Like, what is that specific code? And I don't know if you know the history of that code. Like, how is it possible where you're just borrowing against yourself and yet you can do a write-off? Or not write-off, but deduction.
Tony, our resident tax expert, you want to take this one?
Of course. Traditionally, consumer loans have very limited deductibility. For example, if I were to get, like, my mortgage is over $1 million, I can only deduct up to the interest up to $750,000 on the principal. Beyond that, no luck.
Right.
It was a big hit when I was working for big tech. The tax bill just keeps coming. The way we structure things are different. We're borrowing money using standard listed instruments in the open market, open financial market. You're sort of getting into a position to receive a bunch of money. You borrow the loan and you pay it back. You pay more than you got initially. That manifests as a loss in your investment. Just as if you were to buy GameStop and somehow that were to drop, you can write off that loss. That's the capital loss we're utilizing here. By structuring what would traditionally be a mortgage into what we are doing, we can get around the $750,000 limit that has been put in place to limit the deductibility. And that expands it to maybe 1 million, 3 million, whatever the client would need. So I think it's really important to look at the after-tax cost of financing and consider the overall tax picture.
Got it. If anyone has any questions, feel free to unmute yourself and ask the question, or once again, leave it in the chat as we get to the conclusion. How do you guys see your own products evolve over time? Like, do you is it just more partners that are willing to be in part of this ecosystem? Like, how do you guys see your own product offerings or services evolve over the next 1 or 2 years?
Absolutely. So we grew mostly from a high net worth product, now advisory or like middle market product. In the future, we want it to be a product that is the default borrowing option for anyone that has security. So what that means is we want to bundle it with the easiest access possible, either with a traditional mortgage or with some credit card offering and other ways of borrowing as well. That is our vision. Granted, there's a long way to go to that future, but we would like to contribute at least step by step to move toward where everyone is able to, again, have their assets work for them.
Do you see a world scenario where any of the big banks would be able to partner with you? I know you have the Fidelity and these other ones. They're not real big banks per se, but do you see big banks ever partnering with it, or they got their own walls up? What do you guys think?
We think this might be a product that some regional banks and regional providers might be interested in, just because the big banks are too happy making easy money out of the mortgages and other loans that they have. If they want to slash costs, they can slash costs today. They're not doing that. So I don't think the big banks have everyone's financial interest in mind per se.
Right. Got to make sense. Thanks for answering on the chat, but we'll just bring it up because I know Katie came in late. She just asked, how do you guys charge for this service product? If you want to just answer that one more time. How do you guys charge?
Yeah, of course. So we charge 0.2% on the loan amount. So that is the flat fee that we charge for the service. There's no closing cost or any other kinds of costs. This is the only cost you will be facing in the entirety of using our product.
And so let's walk through a little bit of the logistics. One, let's say someone wants to do this now. How long does it actually take to get this system up? If there are, let's say, already at a Fidelity. So that's the first part of it. And then just to confirm on the cost side of it, it's only the 0.2% of if you actually needed to use it. So you can have this line open, but as long as you're not
Mhm.
using anything, it's still zero. So why don't you confirm a few of those things?
Tony, our operations expert as well.
We don't charge anything on the assets that's being held as the collateral, which is unlike a lot of the banks who offer pledged asset mortgage.
And then how
Uh,
long does it take to get this set up? So if someone wants to do it, like logistically, like what needs to be set up and how long does that take?
As far as the starting process to money, all we need is a margin application, which probably takes overnight for these brokers to process. We can get the money for closing. It would probably take us approximately 1 week to get all the paperwork in, so we can pay off that margin loan with what we do. And that all happens in the same account. So if we have like a week or more, what we can do is we can get ourselves in place and just directly borrow from the market. If we have less than a week, we'll draw our margin, we'll subsidize that 1 week of interest, and then once our paperwork is in, we'll pay off the margin loan.
Got it. And they can always close this off at any time.
That's
Right.
correct.
So let's say if you had $1 million and you wanted to open up a line of 500,000, if for whatever reason they move to another, like let's say they move their
Mhm.
money to a Chase or something, it'll have to be closed. But technically, if there's nothing in it that needs to be paid off, it's no different than a credit card line that just gets closed.
It might be even better than
Absolutely.
that. You might be able to move this loan just like you move your Apple stocks from one broker to another. We support portability to brokers who can take it. Not all do, like Robinhood does not, unfortunately. But there's a wide range that you can keep this loan with you, even if you want to move brokers.
Interesting. To give people perspective, before having this conversation, I've had it with like Chase, because Chase will have a private client arm and they have this option. The speed of what they just shared is significantly faster than these big banks. I mean, these big banks will take at least 3 weeks plus just to have the line ready. It's almost like getting a mortgage, almost like a refinance, right? Like I don't know what they're doing on the back
Mhm.
end and why it takes so long, but it's just what it is. So if you want, if you're like, look, I'm already banked with Chase, and you just want to do that, it's quite frankly a whole lot faster to just move it in kind to like a Fidelity and then open it up with these guys than even just staying within and just letting them run it. Like it's really slow. I don't know the reason of it. I don't. It's probably also because they don't. My guess is they're not making any money until you use it, and so
Mhm.
just like a lot of the lenders right now, they make no money if you have a HELOC. Like they're straight up like almost like most will straight up make no money on the lending, like the lender side, the actual lender that's doing it, the mortgage person. They're not making anything off of it. So they're like, I don't like this is complete back burner. It's more of like I'm gonna do it so that I can help you with other things. But given there's no money, there's no incentive, so there's no purpose, there's no reason for them to even want to do this. So hopefully people have some perspective on that. I asked a bunch of questions. I think I pretty much asked what most may be thinking of, and so we'll get ready to wrap this up unless anyone has any final questions. But is there anything else that you would want to share that maybe either the scenarios or any other questions that I haven't asked as to what people should know about?
Tony, do you have anything?
I can share my personal scenario. My property, the house I'm living in is about 1.6 million. 2021 was the time of the low rates. My mortgage is around 2%. Sounds super low now, right?
Right.
But like part of the down payment I actually borrowed. That was around like 0.5. It's crazy to think about back then. But that's just sort of a benchmark we see consistently between the securities backed loan and mortgage. It could be like 1 or 2% lower than a 30-year fixed mortgage. I got a bit of both. So I probably have around 250 in this type of loan that's deductible and 750 from a mortgage. I did that to maximize my tax deductibility. When I was talking to mortgage brokers, I guess it's a bit unfortunate none of them have thought about it. I guess most of them hear that I'm borrowing more than the jumbo line, they just simply hand out. So one thing I thought could be a good opportunity here is even if you're meeting with a person who has a jumbo mortgage coming in, maybe you can combine this with a conforming mortgage and provide a better overall cost of financing.
Yeah, I mean that's interesting, right? Yeah, because very few people have been ever exposed to this. So on one end, they would just go with a sizable loan because it's just one lender doing it, and they run it that way. On the other end, many are not thinking or figuring out ways on the tax deductibility side of it, which is kind of the other angle that you're bringing it up to. From experience, like how often are CPAs understanding of this? If a CPA is running this, like, is there much education for this? Because I can't imagine this is widely known either. So I'd love to get your feedback on that, like from a CPA perspective, like how much, like, is this a really complicated thing in their eyes, or they just need to know it and then they can put in the tax return side? Like, what have you guys seen from experience from the tax people side of it?
It's actually real easy. I use TurboTax.
Okay.
And what I do is I simply import the brokerage consolidated 1099s automatically, and it pops up. So it gets reported along with me day trading Apple or all the stock losses and just show up nicely in my tax return without me having to do extra work.
That's right, because you'll be able to export it at the end of each year, just like any trades, given it's all like the transactions recorded there, and there's some form that comes out of it.
Precisely.
Right. Okay, makes sense. Yeah. Well, very good. Well, I think we did a good job. Unless there's anyone else has any other final questions, we're gonna go ahead and wrap this up. And thank you guys for your time on this. I hope more and more people learn about this, right? Because these different things that have really been hidden I mean, it has been hidden. Like the super wealthy knows about it because you would see articles and you're like, how in the world are these people borrowing against stuff and not paying any taxes? The logic is you're not selling stocks, you're not selling anything, you're basically borrowing against it. Yet now at least the rate side of it can be very attractive. Of course, every individual needs to feel if they're comfortable with this, but also determine if this is the right decision for them. But our goal of this webinar is for people to at least be exposed to it. And Tony and Joseph are always great to have specific conversations about your scenario, whether it'll work or not for you guys. And I'm sure you can go over your own private situation directly. Feel free to reach out to me if you guys have any questions, and I'm happy to get you guys connected directly. And who knows, this may encourage people to make movements, because the biggest thing, especially over the last couple of years, especially in certain companies, many people's stocks have done really well. And some people don't want to sell it for big gains. That's kind of one scenario. Or others don't want to sell it because they still feel and believe that their stock can keep going up, right? And so having this as an option for people to consider is now something that is here that wasn't as readily available before. So I want to thank you guys for your time on this. And of course, like I said, if anyone is of interest, feel free to reach out to them directly. My contact details will be in the YouTube link below, and hopefully we'll get some action from some of these people that watched it, and also people that check it out online.
Appreciate it, Spencer. Really, thank you for the audience here who bore through our presentation. Let us know if there's any questions that you may have. We understand this might not be for everyone, but we're just excited to share as a piece of information. If you literally just want to learn more, feel free to just reach out. We're happy to answer any questions you'll have.
Perfect. Okay. Thank you, guys.
Thank you, Spencer.
So what do you think? If this is an option that is suitable for you, you got to reach out to either myself or the team at SyntheticFi. There's no cost for these consultations, but if it allows you to accelerate your move or still allows you the option to buy, sell, or upgrade your home, I want to be that resource for you. So my contact details are below, and I'll see you in the next video. Bye now.